What's going on, people? Today I want to give you the basics of an IUL. Now, IUL is really hot in social media right now. It's a really hot topic. Life insurance agents and brokers are talking about it. Online gurus and influencers are talking about it. And a lot of time, the general public is very either misinformed or they misunderstand how it works. So as a real life insurance broker, I want to break it down for you, explain to you how it works and what you need to know about it and how you could actually utilize it. All right? So let's talk about it. So IUL is Index Universal Life Insurance Policy. Okay? So you might be familiar with whole life insurance because it's the most basic form of permanent life insurance. IUL is a universal life policy, which is a lot more flexible in premium and flexible death benefits. So it gives you a little bit more options and more flexibility. But an index universal life is a little different because what that does is give you an opportunity to actually earn more than your standard 4 or 5% that a whole life policy will give you. It gives you an opportunity to do that. So how does it work? In a life insurance policy, they have what's called a general account. That's where they'll pay you your interest from the general account. So each year in a whole life policy, the general account pays you mostly 5% nowadays, okay? Pays you 5%. And I just want to do a side note, it's not the whole 5% you get. It's going to minus fees and stuff like that. But it pays you 5%, then you got to pay insurance costs and all that, right? So the general account will pay you out, let's say 5%, and that's guaranteed, like year after year. Now, how do they make money, life insurance company, to have money in that general account so they can guarantee you money each year? They can guarantee you 5%. No question, safe. Money's not gonna lose no money, always gonna pay you, right? Safe, everything, every year, year after year. How could they do that? They could do that because they're really good at managing money. They put most of their money in bonds, about 70% of it, 50 to 70% in bonds. That's guaranteed money. They also invest in businesses. Like they'll probably buy business. Just like you have equity firm and those type of companies who will go and buy businesses and they're really buying cash flow. Life insurance companies do that as well. They'll look at it and they'll buy a business and they're buying cash flow that's going to be generating, that's paying cash flow. They do that as well. They also do mortgages. They will lend on mortgages. So for example, a bank might say, we'll lend you 80% of the total cost, right? The total all in. We'll lend you 80% of loan to value. This life insurance is a little bit more safe. They might say 50%. So they might fund like a big project, like a commercial building, like a 200-unit apartment building or skyscrapers, whatever. But it's larger commercial properties, but the risk is lower. So instead of going 80%, they might do 50. So they do that and they make money there. They also lend money to their policy owners, right? When you do infinite banking and you borrow against your policy, they're lending you money from the insurance company and you're paying back the insurance company, right? They lend. They also invest in the market, but very conservative, not aggressive, maybe 3 to 10% in the market. So that's how they make money, so they can, in the general account where they can pay for it. So what you're doing in an IUL is that in an IUL, what you're telling the insurance company, that 5% you're going to pay me, I'm willing to give that up and earn nothing if I lose. But I'm willing to put that on the table and you can use that guaranteed 5% that you're going to pay me, right? And now you can use that and buy upside options, which are call options in the market. Call options in an index such as A lot of people mind S&P 500. Many people know that. Bloomberg Index, PIMCO Index, whatever index it is. The company will tell you the index that they have. Pretty much all companies that I've worked with does have the S&P 500, but there are other options as well. But you'll say, go buy options. And if that went over, like if it gained a lot of money, 1 year point to point, meaning from point A, the beginning of the contract year, to point B, the end of it, 1 year point to point, if it gained, then you can share in the gain, right? So you're buying options, you're giving the insurance company the money to go buy options instead of paying you that 5%. Go buy options, and if it went up, then they'll pay you. So when they do that, they have some limitations based on the performance. So your interest credited is going to be based on the performance of the index that it's tied to. So it's tied to an index, but it's not invested. Tied to. Okay? Not invested. What does that mean? That means you cannot lose any of your principal. You do not lose any of your principal. It's tied to, but it's not invested. So you're not throwing in your money in there. You're throwing in the money that the insurance company was going to give you as interest. Right? You're not throwing in your money that you already got. Okay? Excuse me. So you're throwing in money that the insurance company was going to give you. So if the index does well, then you can share in the gain. You have what's called a cap, and you have what's called a floor. The cap is at the max, the ceiling that you will be able to gain. So if the S&P 500 gained 20%, but your cap is 12%, let me write that better. If your cap is 12%, then you're going to gain 12%, not the whole 20, right? And usually your floor is 0. So if you, let's say, I'm just using easy numbers here. Let's say you had $10,000. Let's use 100,000, make it even easier. Let's say you had 100,000 in cash value in there, right? And you gain 12%. You're going to add $12,000. So now you have $112,000. Instead of having your 5%, you would have had 105. Now you have 112. So you have an opportunity to gain more based on the performance on the index and what your cap is. So you'll gain up to the cap. So in this case, the cap is 12%. The S&P gained 20%, you gain 12%. If the S&P gained 8%, you would have gained 8%. If it gained 10%, you gain 10%. If it went down 20%, your floor is 0. You don't lose anything. You lose nothing. All you're losing is that 5% that you are giving up. You don't lose any of your previous principal. So let's say you gained the 12% here. Now you have 112. 112 the next year, it tanked down 40%. You still have 112 because you're not losing anything. You just stay flat, right? You lose the ability to gain more. Excuse me. So instead of getting that guaranteed 5% that you would have gotten, you gave that up. But if it performs well, now you're not only getting 5%, you're getting more. You're able to participate in the high growth of the S&P. All right? So hopefully that makes sense so far. So that's how it works. That's how you're able to get more. All right? Now, what else? You get, it's based on the performance on the index. So you don't really have a guarantee, not necessarily, but there's a few options that you can make sure that you never get 0, right? Remember we said our floor is 0, but you can protect yourself and never get 0. A couple options. So I want to share that with you over here. And the companies I work with, they have these options. You have what's called, you could diversify. Okay, so when you get to choose your index, you can link to several index and you can split up the total account value. So let's say you had 100,000, you could put 20,000 towards that, 20,000. So you can break it down in percent to get a 100%. Hey, I want 50% to S&P. I want 25% to PIMCO. I want 25% to Bloomberg. You could also have the fixed account. So you could still get a fixed account mixed in there. Remember, the fixed account would be the 5% that you would have gotten, right? You could add that. You can blend that in your diversification, or you can just tie to no index and get all fixed. So you can have the option for it to operate like a regular whole life would operate by getting credited from the fix. So it gives you a lot of flexibility. So you can diversify, and you can also not tie. You could not tie to index and get credited from the fixed account. Hey, I think the market is going to be bearish. I don't want to tie to any index. Just give me my guarantee 5%. Done. You could do that. Another option is called the rate lock option. Okay? So let me explain how that works. The rate lock option basically says during that year, that contract year, if you see a rate that you like, you can lock in at that rate. And at the end of the year, that's what you get, whether you win or lose, right? So your cap, let's say your cap is 12%, but you're going to say my rate lock is 10%. If I see 10%, I'm okay with locking it in. So the contract starts September 1st, right? Then in, let's say February you see 10%. It's up 10% right now. You could lock in at that 10%, and when it's time to go again at the end of the year, August 31st, wherever it ends at, let's say it ended at 5%. Guess what? You're lucky. You did it right. You guessed right, right? If it went down 5%, you got 10%, even though it ended up at 5, because you lock in at 10% in February. Now, if it went up to 20%, then you lose that extra you would have gained. So you have the rate lock option. You have the power to actually decide how I'm going to be credited and how I want to do, if I want to diversify each year, if I want to tie to an index, or do I want to use the rate lock option? But you have the ability to kind of work it to make sure that you are active in how your policy is going to perform. So if I was to kind of tell you what the difference between an IUL and a whole life policy is, couple things. The IUL give you more flexibility, whole life give you more straight up guarantee, and then how I would describe one is more passive and one is more active. A whole life policy is more passive. You set it, forget it. You don't need to do anything. You don't have to watch S&P. You don't have to do any rate lock. You don't have to choose an index. You don't have to do none of that. It's passive. Give me my 5%. I'm good. That's it. This is more active in IUL. Investors and savvy people, people who are more financially literate, understand the market, will be more, they don't have a problem being a little bit more active because they want a higher return on their money, right? On their cash value. They want their cash value to grow even more inside an IUL. So hopefully those explain how an IUL work to you. If you're interested in getting an IUL, make sure that you leave that in the comment section. I'll actually leave a link as well where you could actually schedule a consultation I'll answer all your questions. Make sure you get a full understanding. I really want to make sure that all my clients understand what they're buying. They gotta understand it. That's a pet peeve of mine. I don't want people to just buy a policy. Hey, I know I'm supposed to get life insurance. Let me get it and just put it down, and then it collects dust. You need to understand how it works, understand what you're buying, understand how you can utilize it the most and how you can benefit from it the most. All right? So, again, if you have questions, let me know. I'll leave a link for the consultation. And if there's a topic you want me to discuss, make sure you leave that alert. I'm open to suggestion. I'll definitely cover a video in it for you. All right? And if you haven't already subscribed yet, I don't know what you're waiting for. Make sure you subscribe to the channel and hit the notification bell so that every time we drop a video, you're one of the first to be notified. If you like the content, think it's good, it's beneficial, you love the information, then you got to tell me. You got to give me a like so I can know and I can help the channel and move the channel forward and create more content. Now, everything I discuss about IUL today and whole life and all that is in my book. All right? Just dropped this book in June. It's called Get Your Life Together. Everything that you need to know about life insurance as a consumer or as a new agent, it's in this book, right? All the basics that you need to know, everything that you need to know, some basic strategies and more advanced strategies as well. Most of all that you need to know is in the book, so I'll leave the link for you to get a copy as well. Until next time, I'll talk to you soon. Have a good one.